Hi, everyone, and welcome back to Business Ethics. Today, we are going to start thinking about these two terms, shareholders and stakeholders. Now, if you remember back to the lecture on corporate social responsibility, we discussed these big central questions of business ethics, namely what kinds of obligations corporations have. And then we mentioned also this idea of whose interests should the corporation focus on. Something that came up when we were discussing the Milton Friedman article was whether the goal of a corporation should be to maximize the profits. And we were questioning whether that goal should be constrained in any kind of way. Now, last week, we talked a lot about, or rather last lecture, we talked a lot about what obligations corporations have. And we saw that the way that we answer that question can have some serious implications for this second question that we're going to be talking about today. So this second question, whose interests should the corporation focus on? If you remember from the previous lecture, if the goal is to maximize profits, like Milton Friedman argued, then the obligations for corporations are going to look a very specific kind of way. So again, the way that we answer either of these questions oftentimes has serious implications for how we answer the other question. They're very much tied up together. So today we're going to spend a little bit more time thinking about whose interests a corporation should focus on. So the big question, or rather the big topic of conversation here, is a topic concerning corporate ends, what the ends ought to be of a business. And this is, or rather another way of saying this is, or asking this question, or looking at this topic is asking this question of which goals should be the top priority of a business. So the first fork in the road that we hit in answering this question comes with whether we should be focusing on the shareholders' interests as the priority, prioritizing the people who have stock in the company or who own the company, or whether we should be focusing on stakeholders' interests more generally. So someone like Milton Friedman, like we were discussing in the previous lecture, is he's very obviously going to answer with the first one, giving shareholders the priority, the shareholder interests or the business owner interests the priority. And that sort of view is going to argue that businesses should be managed in the best interests of the people who own the business. Now, there are various ways to answer what ultimately pursuing those interests or protecting those interests looks like. One example would be Friedman's view that ultimately that boils down to maximizing the corporation's profits. Now, there's definitely other ways to answer that question. In contrast, we have, in contrast to that, group of views, the different ways to sort of understand what pursuing the shareholder interest would look like. In contrast to that, we have a view that argues that corporations and businesses should primarily have stakeholder interests in mind. That should be sort of the driving force behind the types of decisions that businesses make. So another way of saying this is businesses should be managed in the best interest of anyone who has a stake or interest in the business, including financial interests. So we're not saying to completely disregard the interests of shareholders in a stakeholder theory. Instead, what we're saying is we need to be taking everyone's interests into account, everyone who is impacted in some way by this business. That would be employees, that would be consumers, that would be people, anyone who's affected by how that how that business works. Sometimes that might be some kind of environmental impact as a result of manufacturing. The manufacturing process. It could also be the way that the business might impact or corporation might impact if it's a publicly traded company, for example, how it might impact the health of the economy. So there's a very broad range of interests to take into account, or a very large group of people whose interests ought to be taken into account according to a stakeholder theory. Now, something to bear in mind while we're thinking about these things, especially this debate, stakeholder versus shareholder interests, is that either side aims to explain what is morally permissible to achieve their respective ends. So there's a question for both, whether maximizing profit, even if someone is an advocate for stakeholder theory, is advocating for a stakeholder theory, there is a serious question of, in certain contexts, it might be the case that maximizing profit really does benefit the interests of everyone who's involved. And another question that we would ask of that same theory is, or within that same theory is, what is it to meet the demands of the stakeholders? How far are the effects, say, of a corporation's behavior, like how far do we extend all of the sort of like little causal tentacles, all the different people that it touches? Like I just mentioned, oftentimes for a large publicly traded company, various things that are done within that company might have serious implications for the health of the stock market, right? So when we saw the mortgage crisis, or in the mortgage crisis that occurred in 2008, that was a group of corporations that were trading in a specific way. They were trading stock in a very specific way, tied up within these very bad mortgages that banks were kind of allowed to offer consumers. And as a result, there were some people that were making some really, really fast money, but ultimately it crashed the economy and resulted in a depression for an entire country, right? So in an example like that, when we're talking and we're trying to sort of work through, who are exactly the stakeholders here, we can see that in some cases, depending on the circumstances and the moral questions that we're trying to answer, it might be an entire country. Another thing to keep in mind about what these two different sides, stakeholder theory versus shareholder interests, is that neither side claims that managers should always be able to do whatever is possible to maximize shareholder wealth and or balance all stakeholder interests. So it's not necessarily the case if you are an advocate for stakeholder or shareholder interests for a shareholder theory that you're saying something perhaps as extreme as Milton Friedman argues, where the only thing that corporations or businesses are morally obligated to do is maximize the profits. Similarly, if you're an advocate for stakeholder theory, you're not necessarily saying, as we discussed, Milton Friedman did argue, you're not necessarily saying that the business ought to sacrifice all of its profits and corporate assets for the sake of, protecting what's in providing for the public good. Those are two very extreme versions. We have a lot in the middle to look at. All right, so next what we're going to do is just give a very simple breakdown of these arguments more generally. So first, when it comes to advocating for shareholder primacy or a shareholder theory or shareholder interests, the argument looks something like this. So we first ask, who's the employer? The stockholders. Who are the managers directly accountable to? The stockholders. And the sole responsibility of a manager is to do what the stockholders demand. And usually, but not always, that demand is to maximize profits. Therefore, the sole responsibility of the manager is to, through their business abilities and knowledge, maximize profits. Now, maximizing profits is a complex idea. If it's something short-sighted, just as the what the quarterly numbers look like, for example, that's not ultimately going to, that's not, if that is the sole focus, there's nothing there that's protecting the long-term interests of the businesses, say. So if we understand maximizing profits as maximizing long-term profit, or sustainability of those profits, say, then we can see that this is a more general argument that is not meant to be as extreme as Milton Friedman argued. Now we're going to turn to a very basic argument for stakeholder theory. So, according to stakeholder theory, stakeholders are those stockholders, employees, consumers, and the communities that are affected by or impacted by corporate behavior. Now, as I talked about in a couple slides before, who those stakeholders are really can be far-reaching, right? Sometimes it might just be an individual community immediately surrounding, say, a factory. Other times it might be an entire country. Secondly, corporations are morally responsible for how their actions impact stakeholders. So this is an important feature of stakeholder theory more generally, that corporations are morally responsible for the ways in which their behaviors impact stakeholders. And third, some corporate ventures and actions might maximize profit, but conflict with the demands of employees, consumers, or communities. So in this way, the goal of maximizing profit is ultimately constrained by whether achieving that goal conflicts with demands of employees, consumers, and or communities. Meaning that on a stakeholder theory type view, moral obligations to protect the interests of people who are impacted by that corporation's behavior are constrained by those kinds of concerns that generate from those places function as a constraint on the extent to which a company can ignore the consequences of its actions in order to maximize profit. So the basic idea here being is it's not fundamentally, or stakeholder theory is often cast as a type of like communist or socialist view. Even in the Milton Friedman article, as you read, he phrased it as such. The idea of stakeholder theory is not fundamentally at odds with capitalism or anti-capitalist. It is something that is advocating for a type of culpability that businesses and corporations have on the people that their behaviors affect. So this is where we see concerns. And these are places where, yes, it's permissible for a corporation to say, have a certain type of pay structure up until a certain point, right? Or yes, it's fine for a corporation to exploit features of the market, but only up until a certain point. And and that ultimately the idea that people, businesses and companies engage in a free market, do their best to be innovative, provide a good product, things like this, and reap the rewards of doing so, that's completely fine on many stakeholder theory, according to many different stakeholder theories. However, in general, that kind of pursuit of profit is constrained by the consequences of those pursuits. So shouldn't come at the cost of human life and well-being. All right. So with these points clarified, you are more than welcome to turn to the Freeman reading. Hopefully this will give you a good starting place to get in and understand exactly what the dynamic is between these ideas of shareholder primacy and stakeholder theory. And if you have any questions, feel free to reach out to me or post your questions to your in your assigned discussion groups. All right, thanks so much, everyone, and I hope you have a good rest of your day.